Our first speaker is Ben Harrop from Centuria Capital. His colleague, Michael Blake, was going to be doing the speech today, but Michael broke his leg and is laid up for something like 6 weeks as a consequence of it. Mike has actually had a fairly bad run lately because I was invited to Centuria's 20-year reunion at the end of last year. And it was a day when I was feeling absolutely terrible. I knew I shouldn't be going out. But on the Monday night, Jason Hulich from Centuria was on my program, my TV program, and he said to me on Monday as he walked off, he said, "I'll see you on Thursday." And I didn't know what he was talking about. And then I worked out after he left, he was talking about the special occasion. And I thought, he thinks, if I don't turn up, he'll say, well, he was never going to turn up anyway. And so I had to turn up despite the fact I felt terribly sick. So it was one of those tuxedo events, and Michael Blake came to say hello to me. And as soon as he said hello to me, I chucked up all over him. All over my suit, all over him. And that poor guy now has a broken leg, so he really has had a bad run. Fortunately, no one took photographs of that, claiming that I was a tired and emotional Peter Switzer at a booze up, so I was lucky there. Okay, so Ben Harrop, welcome to the stage.
Sorry, I've got to be careful. So, next 15 minutes, I'm just going to go through about property. So nothing to do with politics, well, a little bit about politics in any case. But I work at Centuria Capital. We're a $5.5 billion commercial property manager. And this morning we heard a lot about equities and shares, but our company have got a passion and love about real assets and direct property. So I just want to take a little bit of a journey about what's happening out there at the moment. But I think everyone in this room is facing a bit of a dilemma. Markets are looking pretty toppy at the moment. In fact, last night the Dow Jones topped 26,400 something, the highest on record. Inflation, weirdly, last quarter was down to 0 in Australia, so really low inflation rates. And obviously, the RBA is talking about loosening interest rates rather than tightening, and we're already at 1.5% and going lower. So I think the challenge has been, how do you allocate your money, your investments, when you know the market's pretty strong at the moment? It's had a very good run the last sort of 8 years or so, and yields becoming increasingly difficult to obtain, but we all need income to live off. I just want to run through, I think property is a really good solution for me in the room to get that balance right between income and capital protection. But the things I'm seeing at the moment is the layers, we've got a lot of stuff going on, trade wars, Brexit, fake news from Donald Trump. I saw the debate last night, it wasn't overly inspiring, but there's definitely a lot of noise out there. Let's just step into the last 20 years. And this is from Lonsec Research. And what it shows you is returns up here and volatility or risk here. And as you'd expect, cash is pretty, over 20 years, just over 4%. And Australian equities has been the best performer in the markets for over 20 years. So if you had the crystal ball, you'd be allocating when you're up into Australian equities with a high degree of certainty for the last 20 years. But there's something missing from this table, which is property. And there's two parts to property. There's the unlisted or direct property and listed property. And just look at the dispersion between these 2 points. So direct property, over that 20-year period, and there's been some tough times in the last 20 years, has an average return just under 10%, but more importantly, a volatility or risk lining up with fixed interest. So I'm not suggesting the same asset class, but I'm suggesting in terms of volatility in your portfolio, direct properties had a really good run. Listed markets, they're the same assets, but when you go on market, you have an impact of the vagaries of what happens overseas and Trump and elections, so you have a little bit of a change there. This next slide is pretty busy, but what we spoke of there was total returns, but we're talking about yield here. So if we drill down to yield, this just shows from 2011. The bottom here is the cash rate, steadily going down, and more than likely going to dip down to 125, which makes it pretty tough if you want to live off income. You put your money in a term deposit. What are most people getting term deposits at the moment? 2.5. Inflation's running 2 and a bit %. So net, you're sort of standing still. Whereas if you look up here, this is international equities, 2.5% yield over that period of time. So international equities are low yielding but high growth. Then we go up to REITs, Australian REITs, 4.5, and then the top here, which is Australian shares. So Australian shares over 20 years have been number 1 in total returns, and probably number 1, they have been number 1 in yield, which has been a great result if you've been in there. But as you know, you're taking market risk on board. So, it's a bit about capital protection, how comfortable are you, how much risk you take on board. But there's been a place in here for definitely Australian equities, but you're taking a lot more risk on board. So when I look about property, there's really two big markets you think of. There's residential, which I'm sure everyone in this room has a residential exposure over your primary residence, or many with investment properties. But let's be honest, that's been a tax and growth story. You get rewarded for making a loss in your property, but you're doing that because you know over time you're going to have strong capital growth, and that's been the case for many, many years. The other option is commercial property, and we're talking about industrial property, retail like shopping centres and offices. So we're not talking about development here, we're just about acquiring those assets. And you can access it three ways, pretty much through the listed market, through REITs, unlisted or direct. But let's just talk a little bit about residential property. Remember, you went into residential property because of tax and growth. Above the line is positive growth, below the line is negative growth. And this is from JLL Research, a big respected research house. If you look up here, this is 12 months ago. Some markets are in expansion, some markets are mature. In Sydney, we're sort of going into that downturn stage. But there's quite a big dispersion between the markets, and property markets are normally not in sync all the time. Roll the clock forward 12 months, this is where we are today. We've compressed. We've gone right into downturn, and most markets are in negative growth territory. So if you invested into residential property, you're now getting negative returns. In fact, today they announced we had 11% negative growth in residential property, the worst result in over 20 years. So it's been a great investment, but now it's getting challenging. If you held onto your resi for negative gearing, you're now not getting rewarded for the growth out of that asset. And I've got Chris Bowen here at the side. If the changes come through from Labor, and Richo believes they're probably going to get in, and it may or may not get through the Senate, but either way, it's going to probably put that downturn to be extended and elongated a bit longer. So if you're not getting growth, let's have a look at yield you get out of residential properties. This goes back to 1980. Our friends at AMP Capital provided this. But it's saying if you invested in here, you're getting a yield around about 2.3% out of residential. So think term deposits, 2.4, so you're getting less than you get out of a TD. This is the 10-year bond rate, and this is commercial property composite between all the major commercial property classes. So pretty much since 1990, you've had a pretty big gap between residential and commercial. So the big question I get asked all the time, well, if we just saw those slides where residential is dipping down and going to a downturn and negative growth, isn't it logical that the commercial would just follow suit? How come they can be disconnected? There's got to be a reason why you'd want to invest into property right now when you've got those concerns over the residential market. And I'd say probably with property, it's running in different cycles to the residential market. Each state is having different growth profiles. Look at WA versus New South Wales, different growth, different strength. But also when you look at property, it's a little bit different. When you go into residential, you looked at location, but we actually think the most important thing is not only the quality tenants and location, but vacancy rates. So you can have the most beautiful building in the best location in the marketplace, but if you don't have the right rental increases, so the covenants over your rent, and you don't have the right tenants in place, it gets pretty tough to make a return out of property. And what we're seeing now is with property, we're seeing all-time lows in vacancies, and that's driven by supply. So if you look around Sydney, the last 5 years, every new building going up in Chatswood or out at Hurstville or out at in the Sydney CBD, they're being pretty much residential because it made sense. You wouldn't put a new office tower up when you can put up a residential tower. So there's been a real choke-off in supply coming into the marketplace. So what are the best opportunities? It's just before we get there, there's a way to access the opportunities. It's very hard to buy an industrial asset or an office tower. They generally go tens of millions, hundreds of millions of dollars. So your choices in the past have been closed-ended funds, listed funds, or open-ended hybrid funds, which get the combination of the two. And our team outside can talk about diversified funds after this presentation. But this is the industrial marketplace. So the opportunity is about $66 billion. The running yield for industrial is about 6.55%. But it's quite a big spread between different markets. So Adelaide is probably sitting up around 8%, and Sydney market's sitting over 5%. So that's a 3% spread in yields in the same asset class. So what's driving that? Two factors when I spoke to our portfolio manager. One has been e-commerce. So if you want to shop online, you need to have, it should say 15 kilometres, you need to have a warehouse within 15 kilometres in the metro region to deliver those goods. And pretty much it's been really hard to buy property in that space because it's gone to resi. So what we're finding now is there's been a lot of demand now for industrial, which is driving around valuations, and the yields are being pretty sustainable. The other thing, the government's been spending a lot of money in infrastructure. So huge amounts of money in infrastructure, which means we have to warehouse all that inventory and stock. So industrial market's been very strong, probably one of the strongest markets globally in Australia because there's been limited supply of new stock coming on board and strong demand. And going forward, will this be sustainable? Well, at the moment, about 5.5% of all retail purchases are online. Globally, it's 11.9% average. In China, it's 28.6% online. So you measure how many industrial assets you'll need to build if we go from 5 to 11 to 28%. It's going to be huge. So we believe the industrial market will continue to be relatively strong. The other market's office. So the office market's about $288 billion worth of opportunity there. The running yield's sitting about 5.41% on average. But Sydney has definitely been a market which has been pretty tight. So a couple of years ago, the yields were running at about 7%. They're down at 5s. But then you look over in Perth, Brisbane, Melbourne, there's still some disparity between those marketplaces. But office is now, it's had a strong growth run, but it's now moving to a yield play. And the reason why we're sort of saying, well, office will probably continue to be a strong asset class is really about new stock. There's little new supply coming on board till 2021, especially in the Sydney and Melbourne and Brisbane markets. Most new developments, when you're seeing the cranes go in, 70% has already been pre-committed, which means you've already said, I'm not going to build that building unless 70% of the tenants have already agreed to go in there. And we're seeing a lot of demand from white collar. Probably the only concern is what happens if the economy dips down a little bit? What about demand? If you go to a modern office nowadays, you've got 80% capacity for 100% of the staff. So you have to fight for a desk in the morning to get, if you've got open plan offices, because you don't all have a desk nowadays. But what we're seeing now in the US, there's movement to serviced offices. There's a company called WeWorks in the States, and they're now the biggest landlord in New York with 5 million square feet. And they basically let out small startups, individual companies, small companies on a month-by-month lease. So that's a big change, and we're seeing that happen in the Australian market as well. This is an example of one of our assets, Zenith Tower. It's a single asset. We bought that back in 2016 for $279 million. We saw it as an unloved asset, meaning the previous owners hadn't really done much to it. They hadn't spent much money on lifts, refurbishments, end-of-trip facilities, and as a result, we spent a fair bit of time improving it. The last valuation was $415 million. It's not a bad result in a couple of years, but more importantly, it's had a 7.5% yield. It's a nice running yield coming off that asset. How do we make it a little bit better? By improving the services in there, we're able then to push up rents. One of my students about vacancies and rents is important. We moved the rents from an average of $476 up to $545. So that's a big change. That's a big accretive lift in the valuation of that asset. So just in summary, commercial property outlook and politics, we know there's going to be some push down in yielding stocks. We know there's going to be changes to CGT. But what doesn't change is the fact that when you buy a building, you tenant it well, you lease it out, you get a good rental income from semi-government and government tenants, it's pretty stable. What will change is valuations, but we find with valuations they change about every 6 months over time. So it's a smoothing kind of approach to investing. We also believe going forward, as I said, new stock's not coming online for another couple of years. There's a big dispersion between marketplaces. So there's definitely an opportunity in direct property. Even though we're going through a lot of noise, a lot of political uncertainty, property still provides a really good solution for yield. And lastly, a little bit about us, Centuria. We all believe about value add for buildings. We don't buy something unless we can see some upside in it. We don't buy unless we can see the opportunity to change the tenants over. And as a result, we target buildings with a 6 to 7% yield, and we've been able to find those. It's tough, it's hard, but you can find it out in the marketplace if you don't rush in. We've been doing this for over 20 years and had about 38 syndicates out in the marketplace. So I think if you're looking for diversified income, a little bit more stability, property is definitely an area which you want to explore. Thanks.
Thanks, Ben.